Hi there guys, Andrew Baxter here and welcome to the blog. And this week what I'd like to tackle is a question that's come up multiple times from a few different sources actually. And it relates to new options traders trying to get a better return on their money, but actually going backward as a consequence of it. And that comes down to the simple conundrum, sometimes more is not a good thing. When we look at option premium, the amount of income that we're able to generate from trading options, one of the critical factors, and there are in fact two, one is time component, the second one is volatility. Volatility is what we're going to focus on here. And I was talking to somebody just the other day and they were suggesting that the trade they were in was a better trade because it was yielding around about 4% for the month. However, 4% for the month does come at an expense, and in this case that expense is defined by risk. You see, if an option has got a higher volatility component, then it would be deemed as being a stock or an option that moves around a lot more and therefore contains more risk for the client. So here's the thing, if you're a covered call trader and you're looking to structure the strategy to suit you, and my advice is definitely customize the strategy to suit you, seeking out higher return can be quite dangerous because all that glistens isn't gold. If we were to look at, say, 3 example trades, and we could look at these, say, for example, on the Australian market. And if we were to look at these in terms of Fortescue Metals, FMG, if we were to look at them, the second one may be BHP, and the third one, Telstra. From an options perspective, the premium earned over here on Fortescue would be the highest, because Fortescue has the highest level of volatility from these 3 trades. Equally, BHP would be in the middle, mid, because it's got a more softer level of volatility than Fortescue. There's a reason why. Fortescue is in the iron ore business, that's all. BHP is a diversified mining business, therefore is involved in many sectors and therefore would be a lower risk and therefore lower volatility. Finally on here, Telstra. Now Telstra obviously is a telecommunications company, almost a monopoly here in Australia, and has probably the lowest risk of these 3 and therefore the lowest volatility. And whether you would have it in your portfolio would come down to a couple of things. Someone looking to do covered calls with Fortescue would be someone that's happy with that high level of risk and therefore a potentially high level of return. Someone that's invested in Telstra, they might be in it, for example, for the fully franked dividend that the company pays, giving it an enhanced yield. And as a consequence of its lower risk, lower volatility, pays out much less from a covered call perspective. So unlikely to be something that you'd be seeking to do covered calls on. BHP somewhere in the middle. Now, understanding this sliding scale when you're starting out, you want to learn the strategy without too much risk. So you're going to be playing probably more in this space here between these kinds of stocks. As you become more proficient and perhaps understand the way that return is generated, you may start to crank your target stocks up this way into a more aggressive format. So there isn't a one-size-fits-all when this strategy is used. You need to tailor it to suit you. Now, of course, if we were looking at this across the US market, and to give you some examples of some household names there, if we take a stock like Pfizer, large pharmaceutical company, it's a fairly steady as she goes stock. It's been a little bit volatile over the last couple of weeks, as a matter of fact, but lower volatility and therefore lower premium and income. Somewhere in the middle here, we might sit Disney. Good household name again, and certainly a higher level of volatility than Pfizer, but not as high as, say, for example, Tesla, electric car and battery business. Higher volatility and therefore a higher return. So again, depending on where you are in the journey, if you're new, you probably want to start with something that's a little steadier as she goes and push yourself on this journey, and maybe this area of higher volatility just isn't for you, period. You're quite content averaging out that sort of 1.5 to 2.5% type return in this space, as opposed to what might be 3.5 or 4% here, or 1 to 1.5 here. So that's the important thing. People often pigeonhole a strategy like covered calls and go pedestrian, boring strategy. But it doesn't have to be, because you can tailor it to suit your needs. Just be very, very aware, if something is paying a higher premium, it's because it has a higher level of implied volatility and will therefore come with a higher level of risk. If you understand those things and you're comfortable with it, fantastic. If you didn't understand those things, then let us teach you a little bit more on how that works, so you can avoid being caught in a situation where what you expected to happen didn't happen. In fact, the reverse did. Instead of making money, you got caught out and ended up losing some. That's this week's blog. Understanding the volatility of the stock will help you choose your income potential from it, and make sure you understand that chasing yield or higher call premium does come with a level of risk if you don't understand the dynamic of the underlying business behind the stock.